Welcome to Money Depth Insights. I am the finance guide, John Array. Today, we are not talking about stocks, charts, or market timing. Today, we are talking about you. Because long-term success in investing is not decided by intelligence, education, or even money. It is decided by psychology. Two people can invest in the same market at the same time with the same information and still end up with completely different results. The difference is not knowledge. The difference is how the human mind behaves under pressure. This session is about understanding that behavior calmly, clearly, and honestly. Part 1. Why psychology matters more than strategy. Most people believe successful investing is about finding the right strategy. In reality, strategies fail not because they are wrong, but because humans fail to follow them. Markets move. Prices rise and fall. News changes every day. But the biggest movements happen inside the human mind. Fear, greed, impatience, regret, and overconfidence silently influence decisions, often without the investor realizing it. Successful investors are not emotionless. They simply understand their emotions and do not allow those emotions to control actions. Psychology is not an add-on to investing. It is the foundation. Part 2. The emotional cycle of every investor. Almost every investor passes through the same emotional stages. At the beginning, there is excitement. The idea of money growing feels empowering. Then comes hope. Small gains create confidence. After that, confidence turns into overconfidence. This is where danger begins. People start believing they understand the market completely. They take larger risks, ignore warning signs, and stop listening. Then reality arrives. Markets correct. Losses appear. And emotions shift from confidence to fear. Fear causes panic decisions. People sell at the worst possible time, not because the investment is bad, but because emotions demand relief. This cycle repeats for most people. Successful investors break this cycle by recognizing it early. Part 3. Fear, the silent destroyer of returns. Fear is not always loud. Sometimes fear sounds like, what if I lose everything? What if I wait and it gets worse? I should exit now and think later. Fear focuses the mind on short-term pain, not long-term outcomes. The market does not reward those who avoid discomfort. It rewards those who can stay calm while others panic. Fear makes people sell low. Patience allows people to buy value. Understanding fear does not remove it, but it stops fear from controlling decisions. Part 4. Greed and the illusion of control. Greed is often misunderstood. Greed is not just wanting more money. Greed is the belief that current success will never end. When investments perform well, the mind starts creating stories. This time is different. I should invest more. I can handle more risk. Greed reduces caution. It replaces discipline with confidence that feels logical, but is emotional. Markets punish greed not immediately, but eventually. Successful investors respect growth, but they never fall in love with it. Part 5. Overconfidence and the danger of short memory. Overconfidence grows quietly. One or two good decisions can convince the mind that skill caused the result, even when luck played a role. This leads to ignoring risk, taking unnecessary positions, rejecting alternative views. The market has no memory, but humans do, and that memory is selective. We remember wins more clearly than losses. Successful investors constantly remind themselves, past success does not guarantee future outcomes. Humility protects capital. Part 6. Why most people buy high and sell low. This behavior seems illogical, but it is deeply human. People feel comfortable buying when everyone else feels confident. Prices are high, news is positive, and social proof feels safe. When prices fall, Fear dominates. Negative headlines reinforce panic. The human brain prefers emotional safety, not financial logic. Successful investing requires acting against emotional comfort, not following it. Part 7. The power of patience and time. Time is misunderstood. People think patience means waiting without action. In investing, patience means allowing processes to work. Compounding needs time. Businesses need time. Markets need time. Impatience interrupts growth. The most successful investors do very little, but they do it consistently. They allow time to do the heavy lifting. Part 8. Discipline. The invisible advantage. Discipline is boring. It does not feel exciting. It does not create stories. But discipline creates results. It means following rules even when emotions disagree, staying invested when doubt appears. Avoiding decisions driven by headlines. Discipline protects investors from themselves. Part 9. Long-term thinking versus short-term noise. Markets reward long-term thinking. News rewards short-term attention. Successful investors understand this difference. They observe markets daily, but they think in years. They do not react to noise. They respond to fundamentals. Clarity comes from zooming out. Part 10. The identity of a successful investor. Successful investors do not ask, "What will the market do next?" They ask, "How will I behave when uncertainty appears?" They focus on process, not prediction. They accept uncertainty as normal. They know the market does not need to make sense every day, only over time. Part 11. Loss aversion and why losses feel stronger than gains. One of the strongest psychological forces in investing is loss aversion. Human beings feel the pain of a loss almost twice as strongly as the pleasure of an equal gain. Losing $100 hurts more than gaining $100 feels good. This is not weakness. This is human biology. Because of this, many investors hold losing investments too long, sell winning investments too early, avoid good opportunities after one bad experience. Successful investors accept losses as part of the process, not as personal failure. They understand that avoiding all losses is impossible, but controlling behavior is not. Part 12. The need to always be right. Many people unconsciously connect their self-worth to being right. When an investment goes wrong, it feels like an attack on intelligence or identity. This creates resistance. Refusing to accept mistakes, justifying poor decisions, ignoring new information. The market does not care about ego. Successful investors separate identity from outcomes. They do not need to be right every time. They only need to be right often enough, with controlled risk. Part 13. Information overload and decision fatigue. Modern investors consume too much information. News, social media, opinions, alerts, predictions all compete for attention. This creates confusion, anxiety, and decision fatigue. When the mind is overloaded, it seeks relief, not logic. That relief often comes in the form of impulsive action. Successful investors limit information intake. They focus on what matters, not on what is loud. Part 14. Social proof and the crowd effect. Humans are social by nature. When many people believe something, the brain assumes safety. In markets, this creates bubbles and crashes. People buy because others are buying. They sell because others are selling. The crowd feels comforting, but the crowd is often wrong at extremes. Successful investors respect the crowd but do not follow it blindly. They think independently, even when it feels uncomfortable. Part 15. Confirmation bias and selective thinking. Once people believe something, they unconsciously seek information that supports it. They ignore evidence that contradicts their view. This is called confirmation bias. In investing, this is dangerous. It traps investors inside their own opinions. Successful investors actively look for reasons why they might be wrong. They treat opposing views as protection, not threats. Part 16. The role of routines and systems. Psychology becomes manageable when decisions are system-based. Successful investors use routines, regular reviews, predefined rules, clear risk limits. Systems reduce emotional decision-making. They remove urgency and replace it with consistency. Discipline is easier when systems are clear. Part 17. Why simplicity outperforms complexity. Complex strategies feel intelligent. Simple strategies feel boring. But complexity increases emotional pressure. When things go wrong, complex strategies create doubt and confusion. Simple systems are easier to follow during stress. Successful investors choose clarity over complexity. Part 18. Long-term confidence versus short-term emotions. Confidence built on short-term results is fragile. One market correction can destroy it. Long-term confidence comes from understanding process, risk, and probability. Successful investors trust their process more than daily outcomes. They measure progress in years, not days. Part 19. Accepting uncertainty as normal. Markets are uncertain by nature. Trying to eliminate uncertainty leads to overtrading and stress. Successful investors accept uncertainty as normal. They do not need certainty to act, only reasonable probability. Peace comes from acceptance, not prediction. Part 20. The final mindset shift. At its core, successful investing is not about controlling markets. It is about controlling responses. Markets test patience. They expose emotion. They reward discipline. When you master your psychology, strategies start working naturally. Final reflection. Successful investing is an internal skill before it becomes an external result. The market does not defeat most people. Their own reactions do. When behavior aligns with logic, investing becomes calm, steady, and sustainable. If today's topic helped you think differently, share your thoughts in the comments. And if you believe this understanding can help someone in your colleague or friend circle, make sure to share it with them. This video is created for educational purposes only. For more deep, clear, and practical financial understanding, subscribe to Money Depth Insights. I am the Finance Guide, John Array, and this journey of clarity continues.